Hello, everybody. Welcome to the Listing Agent Podcast. My name is Keith Hernandez.
And I'm Jaslene Chavez, and we're really excited to have you here at the Listing Agent Podcast. We are a community-based real estate platform to help you grow and thrive in your business. And we're really excited to have Marc Viana on the show today.
All right, Marc.
Thank you, everybody. Thank you so much.
Marc, introduce yourself a little bit. Tell them who you are.
What's your favorite color?
How long you been in the business? Where do you like to go eat for dinner?
Too many questions all at once, everybody. Hello there. Geez, you messed me up already. Hey, my name is Marc Viana. I'm the broker owner of MVP Lending. We are a Southern California-based lender. We are a direct lender and a broker. As far as my favorite color is concerned, it's actually magenta. And I like long walks on the beach. I love that kind of stuff too.
Oh, nice.
Yeah. Favorite restaurant is probably going to be an Italian place in Orange, city of Orange, called Mascarpone's. My wife and I have been going there for I don't know how many years. So there you go.
Shout out to them.
Yeah, it's absolutely.
Nice. All right. Well, I guess today we're going to talk about buyers and the market. So what do you think, Jaslene?
Well, let us know how'd you get into lending? Because with me, I didn't wake up one day like, I want to be a realtor. That's my dream job. You know, how did that look like for you?
For me, actually, I've been lending now. My older daughter is 28, and so 26 years I've been doing this. Mm-hmm. I used to work for Blockbuster Music, and you guys are kind of young. I'm a little older. So anybody who remembers Blockbuster Music, I was a store manager there for a number of years, and was making great money, a whopping $36,000 a year. Mm-hmm. So this was, 28 years ago, so it was great money. And in any case, I needed to make more money. I wanted to get more into a profession. I was a single dad, so I needed to make more money to make sure I paid for my apartment, utilities, food, groceries, all that kind of stuff for my daughter. And I had a client who would come in, and he always had a big fat wad of money, and he had two kids. And he was a police officer. Got injured on the job, got retrained as a loan officer. And I asked him what he did one day. He would come in every week on Friday like clockwork, and he would buy anywhere between $200 and $300 worth of music every week for his two kids. Oh, wow. And it was like, I want to, whatever you do, I want to do that too.
I want that wad of cash.
I want that wad of cash.
I'm
thinking, oh my God. And so we got to talking. He started training me, and he started training me in the business. And I had quit my job and thought I was going to be working for him in the company he was at in the city of Tustin, where I was living at the time. And it turns out the guy was a pathological liar. Oh yeah, no, it gets better. Oh yeah, so pathological liar.
Not a cop.
No, he was a cop, but he didn't have the pull at the company that he worked for that he told me. And the walls were thin. And as I was sitting out thinking it was my first day, I heard the owner. Can I swear? Oh, let me just say beep then. They were beep. Fuck it. Let me just be me. So
beep, beep, beep.
The guy said, "Who the fuck do you think you are trying to hire somebody because you don't have that kind of authority? This is my company. I own it. Blah blah blah." And it just went horribly south from there.
Awkward.
Super awkward.
That's so awkward.
It was even more awkward when I had to cry and beg for my job back because again I had to worry about me and the kid. So I got the job back, and then a few months later, another guy would come in on a regular basis. Guy's name was Derek. He was the manager for a company called Consumer First Mortgage.
Wad of cash?
Nope, not a wad of cash. Super cool dude, super cool guy. And he always thought my customer service skills were great. He's all, hey, have you ever thought about doing this? And I said, oh, yeah, I did. It was a bad experience. I'm not going to do that again. He's all, well, no, check us out. We're an actual real company. We're this and that. He's all, I'm the manager. I'm the telemarketing manager. You'd be great, blah, blah, blah. Started working there, quit the job again, started working there. There was a discrepancy in pay where I actually lost half of the income that I had when I was thinking I was going to be making 1.5 times. So I thought, hey, in my small little brain, that's great. I'm going to make more money. I'll only have to work the weekends. I can not have to worry about working working during the week. I don't have to work the weekends, make sure that my daughter's okay. And turns out, the pay was half. And the very first day I figured that out during lunchtime, I had cried because I ended up having to borrow money from my parents to get dress clothes because I didn't dress like that. Blockbuster Music, it was a blue T-shirt and jeans. I got that nailed down now.
Don't tell me you begged for your job back a second time.
No. I did not beg for the job back, but begged my parents for some help. and they gave me some help. I did everything that I could do and think of as far as getting better skills, as far as selling and that kind of thing. And then about 3 months later, I became a loan officer. And then it kind of, had some more ups and downs because I was just a dumb kid, to be super honest. And then I finally, about a year later, hooked up with some guys who actually really took me under their wing, really gave a shit about me, and really tried helping me get better. And I gave myself 6 months. And I remember the first check I got from those guys was $3,589.63.
Wow.
Mm-hmm. Yeah. And this was like 26 years ago, 25 years ago. And
that's number forever, ingrained in your head.
I remember I got that check and the money was gone instantly.
Did you go to Vegas?
No.
Don't tell me you bought music.
No, did not buy music, but I started paying my parents back. I started paying friends back, and then like 2 weeks later, I think 3 weeks later, I closed another small little deal, and then it just started going from there. I mean, I think I made $53,000 my first year, and then my second year I made over $100,000, and it was like, oh my God, I am so rich. So.
How young were you when this was all going down?
I was 24. So yeah, I did have the same disease a lot of folks had, as I ended up making way too much money, way too soon, too young, not having the correct kind of financial management skills and life skills to be able to allocate money correctly.
Yeah.
What was the loan business like then compared to now in terms of trying to get business?
I was about to say, how'd you get all that business so fast?
You know what the guy did, Richard Marquez and Rick Kessler, actually, two dudes that really helped me. What Richard did is he brought me to his office, and he actually printed out on his computer. He spun his chair around, and he printed out a stack like that of papers with real estate offices in the city of Santa Ana, because our office is in Santa Ana. And he said, okay, go door knock those guys and ask them if they need a loan. Well, I was young and didn't know any better, so I said, okay. So it was like, knock, knock, knock. Hey, is Pacific States Mortgage, is Marc Viana, we do loans. Get out of my office. I remember hearing a lot of that kind of stuff. So in answer to your question, Keith, yes, it's about the same. It's still the same: cold calling, door knocking, and sphere of influence. I mean, those are some of the main things that you can do as far as business goes. I mean, as far as the difference now, I think back then, I want to say a lot of realtors were probably a little bit more lenient to newer loan officers, whereas now, not as much. Not as much.
You have to have like that partnership today. Which
yeah,
is
partnership is pretty strong, pretty huge. Yeah.
But tell us, okay, so in your opinion, how are rates doing right now, and how are rates determined?
Well, how are rates doing now? Hey, the rates are doing great right now because they've been on a downward trajectory over about the last 4 weeks. So again, I'm not sure when this is going to go live, but right now where we're at, rates are looking good. They kind of bounce back the other way because of the jobs report that happened today. So we'll see how it goes. I mean, overall, fundamentally, again, as I mentioned, I've been doing this for about 26 years. If you're looking at rates in general, a rate range between 5% and 7%, okay, for a 30-year fixed rate mortgage is going to be a healthy market. Okay?
Yeah,
that's really where you want to be. Now, I do recognize that because we had artificially lowered rates that were at a lower rate range for way too long. We are Americans and we have a short attention span and short memories. So right now, I think people are okay with having a higher rate, like maybe something in the 5s or 6s. Not everybody is, but people are in general. People can see that's kind of where it is. Now, what messes people up psychologically, or where they get super emotional about it, is when there's a fluctuation, meaning a rapid fluctuation in those rates, when they spike up or spike down. But when they're stable, say between like the 5.5% to 6% range, people can handle that because you psychologically are ready for it. But then when they drop down, you think, oh my goodness, I have to get locked in right now. I gotta get my offer accepted right now. Or if they spike back up, say over 6% or 6.5%, it's like, oh my God, I'll never be able to afford a house.
Yeah.
Okay. So again, it's as you both know, as active agents, you are therapists. And you're the best friend, and
therapist, financial advisor,
and you're the financial advisor. You're their banker at times. I mean, all those kinds of things. So
you need to get paid more. I think.
Absolutely, and then as far as how rates are determined, it's based off the 10-year Treasury. That's how 30-year fixed rate mortgages are generally.
Yeah, and it's crazy. Like last year when the rates spiked, I mean, you had so many people who have never bought in before, so they got shocked and they got nervous, and they thought this is the end of the world. But at the end of the day, like you just said, going back down to a 5 to 7, you said?
Yeah, 5 to 7.
It seems it's a normal market. We just got so spoiled by COVID rates.
When I think of you as a lender, I'm like, okay, unconventional. You read between the lines. Like, I like that. Get kind of creative with it.
Yeah. So to kind of go back, let me kind of answer that. So as far as being unconventional lender, the way I started my career is back in the old days. I started the business before there was DU. Okay, so it was actually just the lender calling and saying, yes, your client's qualified. Here's the approval letter, and you're good to go. So that was manually underwritten files. You had to actually look at pay stubs yourself and calculate it. Processor would calculate it, the underwriter would calculate it, and then you would say yes or no. Okay. So a lot of what I did in the beginning in my career was tough FHA loans. And it's funny because we moved to a new house about 5 years ago. I just realized 5 years ago, and I was cleaning up my side of the garage the other day. And my wife said something, and I found a box of old commission checks. And back then, in the I guess it was the late '90s, early 2000s. The average for me loan amount was like somewhere around $225,000, maybe $250,000. Wow. And yeah, it was crazy. Wow. I mean, some of the checks were so small. I'm like, oh my God, no wonder why I used to have to do a crap load of business. I wasn't really making very much. But hey, I'm still super blessed and fortunate. But anyway, to go back, so it was always tough FHA loans. Like I remember having one client who had 2 bankruptcies, okay? 2 bankruptcies in a row, 7 years and 1 day apart. And we had to approve their loan, and then we denied them at the last minute because it turns out there was a 3rd and 4th bankruptcy they didn't bother telling us about. So basically what these clients used to do with the bankruptcy laws is they would jack up all their credit cards, file bankruptcy. Get new credit cards, jack them all up, file bankruptcy, and never pay anything back.
Wow.
Dang.
Yeah. So that
karma's going to get you.
Well, yeah. We actually
working the system.
Oh, they absolutely worked the system. So unfortunately we denied that loan. But my point is always tough stuff like that has always been around. Then it morphed into in the 90s and early 2000s. It morphed into being called Alt A. Okay, so alternative financing, not A, but maybe like a B plus, maybe A minus, B plus, maybe B. And then now, since Dodd-Frank went into place, it's been called non-QM. So a regular quote unquote conventional or FHA or VA, USD, those are called qualified mortgages. That's the technical term for them. The stuff that I really focus in on and do really well is called non-qualified. So it's out of the box. So maybe someone who's got a little bit higher interest rate, higher debt to income ratio. Okay, a little bit rougher credit. Maybe a little bit more rougher ways to qualify their income as far as being able to document their job history. They're going to receive a little bit higher interest rate, but they're still going to be able to qualify. Okay, so I mean, there's all kinds of different versions of those kinds of loans and what we would use to document your income. And we even have loans that we don't even look at income at all. We go like this. Okay, and no income, and we just verify the assets. So it just depends.
But I also feel like your previous work when you were a newer LO, right, kind of prepared you for that because you said you had a lot of difficult FHA loans when you started out. You had to manually look at all that stuff.
Oh yeah, and I still do. We still do FHA. We still do conventional. We still do all of those kinds of loans, and a lot of what we see now. It's funny since the pandemic. Like you're talking about, Keith, what we've seen and we've transitioned more into a lender that is the we're the savior loan kind of lender, or you've been turned down once, twice, 3 times somewhere else, and you come to us and we make it work. I mean, we've got one right now that Loan Docs went out on it. It's an FHA loan. Loan Docs went out on it yesterday, and we're going to fund, I think, on Monday. And apparently I had no idea until I talked to the buyers about a week ago, and they finally confessed to me that we are the 4th lender. And they've been in escrow for about 95 days.
Wow.
So how is it that you can qualify them, right, and the other lenders can't? Is it just like the overlays that the other lenders may have, or?
I don't think overlays are the thing, because overlays are just something that some lenders have and some lenders don't have. I mean, as far as, say one lender can do this one thing over here, but this other lender can't, because whoever they sell their loans to. Because the reality is all lenders sell their loans. I don't care if somebody is going to tell you, oh, we don't sell we're loans. No, they're a fucking liar, because you have to sell the loan to get the money back to be able to do more loans. Like, for example, the big banks, Bank of America, Chase, Wells Fargo City, whoever it is, they all sell their loans too. Now, they may retain their servicing rights, which is different, okay? Where that means they'll get that monthly payment every month, okay? But they're not gonna just get that $600,000 loan or $500,000 loan and leave that money there. They're gonna get that money back, so they can lend it to somebody else, okay? So I think it's, the overlays aren't necessarily what it is. I think it really is structuring, and I think the experience, Jaslene, I think it's really what it comes down to, of being able. I've done a lot of just fucked up loans. Just like I mean, it's funny because you guys have been doing this long enough and you guys have other friends, you hear other loan officers come and says, we do make sense underwriting or common sense. Here's the reality. No one does fucking common sense underwriting anymore, because everybody's too afraid of not being able to sell that loan. Okay, now back when I started, lenders did common sense underwriting back then because you could. Okay, it was okay, where there was a lot more leeway than there is today. Okay, so you could take a file like the bankruptcy guys, like I said before. I like them. I believe in them. I talked to the owner of our company and made the case for why we should do that loan, and we got approved. We got loan docs out, and then we did a final fraud check or something like that, and they popped up 2 more BKs. It's like, oh, well.
Question. So some people are like, should I just pay all cash for the house, or should I take out a loan, right? What are the benefits of taking out a loan, and how can you leverage a loan more than you can leverage just a cash transaction?
Well, I think right there, as far as leveraging a loan is leverage it speaks all the way around. I mean, again, I think you guys are both investors yourselves. You understand that leveraging somebody else's money is going to help your money go much further.
Yeah.
And I would tell people too, if you have the cash and you need to close escrow now, absolutely do it. Yeah. But let's take a look at what your short-term goals are. Let's take a look at what your long-term goals are. And show you some numbers to show you how beneficial leveraging really is for you.
Yeah.
Okay. And I think that, to me, that's always the thing. I mean, I've got a client right now that I'm actually talking to her this afternoon. She did not want to use any kind of financing whatsoever, but now she understands leverage. We've had a couple of conversations. The realtor had a conversation with her as well. So now she's on board. So instead of buying it all cash, she's going to put 50% down. I'm trying to convince her to don't put 50% down, put 20% down or 30% down, because you can take that other money and buy something else.
Yeah. So money's not tied up in the house.
And that's the thing is like for us on the lender side, when we're talking to clients, we always have to preface that with, hey, look, we're not trying to get you to do a higher loan amount or do more loans, but think about it for a moment. Put the least amount down. As long as you're comfortable with that payment, you can then take that money that's left over and buy something else. And that to me is it's where the magic is, where the gold is, because again, you as the realtor can also speak to that from experience, saying, hey, yes, if you do this and go minimal over here, you can go minimal over here, and now you've got 2 versus the 1.
So for investments, what is the minimum down you can get away with today?
I do miss the days of lower down, but for investments right now, you're looking at 15%. So, which is still great.
That's actually really good.
Which is still great, because that actually includes even duplex, triplex, and fourplexes. Okay, so 15% down is all you're looking at.
But thinking about it like that, like not having to touch your first your mortgage payment at such a low interest rate, because that's what you'd have to do for refi cash out, right? You would have to literally go to whatever the interest rate is at this time.
And that's what I see with like a lot of investors, and we'll even go back to first-time home buyers, okay? Even first-time home buyers, or even investors who maybe have 1 or 2 properties. It's shifting that mindset a little bit of, okay, if I give a little bit here, I get so much more here.
Right.
Yeah.
Hey, if I can pay a little bit more principal, hey, I'll do it. But if not, I can take those funds and move it over here. Now, sometimes you get, as you guys, I'm sure, know different people, where you may over leverage yourself, because it's pretty easy to do. As I'm sure, as you've seen with just doing your own flips, Jaslene, it's Keith, again, same thing. It's just difficult to sometimes manage if you're new, unless you've got someone who's kind of holding your hand and making sure that you're not going too crazy, because all of a sudden you could go upside down pretty quickly.
Like you said, it's all about leveraging your money, for sure. Definitely. You want to make sure that investment is making money.
Yeah. So talk to us about, say I'm a business owner and I want to buy a house, right? I have really crappy credit. Is there a loan for me, or would you tell me to improve my credit, and what are some tactics that I can do to improve my credit?
Well, how bad your credit?
Say I'm at like a 560.
All right. So what
I can do it.
probably
He knows a guy.
I know a guy. I know a girl too. No, I would really start with depending on what kind of a down payment do you want to put down, what kind of monthly payment are you looking for, and how long are you trying to keep this house for? I'd probably ask those three main questions. Okay, and let's just pretend they want to keep it. It's their forever home. Okay, cool.
Yeah.
Okay, you're at a 560 right now, so your credit sucks. You know that it sucks. You don't need me to tell you. Okay, but we've got a couple of different people that we use for credit repair that we would connect you with, and depending on how severe that 560 is, meaning how bad it is or how bad it isn't, because believe it or not, when people, this is going to sound strange, but when people are upfront to me and say, hey, you know what, Keith, my credit's horrible, it's not as bad as they think it is.
Yeah.
It's when they lie and say how great it is, it's terrible. Okay. So if they're up front, if he's up front saying he's a 560, then he's probably not as bad. But we'd get him some credit repair. We'd also give him some tips and tricks on maybe negotiating, if there's any old collections on there, if there's any negotiating. Generally, what we're seeing right now is we're seeing people that have that 10 to 20% down and their credit sucks. And it's like, well, if you just take, let's just $5,000 of the money you have saved, your credit can be spectacular. So let's do that. So instead of putting 20% down, we put 15% down. Okay, so that way we're putting you in a position to win, to be successful.
Rearrange the money.
How long does that process take to try to fix their credit?
Depending on how severe it is, it could take anywhere from 30 to 60 days. I mean, I've got one right now that only had one negative item on their credit report, and it took 27 days. 27 days. So it was actually pretty quick.
Actually, not bad
at
all.
It was phenomenal. It was super inexpensive, and it got done. And it's actually going to be permanently deleted. So then I've got some clients who it's taken 8 or 9 months because they were bad, bad.
What about for the buyers? They make a lot of money, but their taxes are crappy. Do you have any programs for them or any non-traditional lending?
Yeah. So for someone like that, again, if they're self-employed, and again, you say they have great cash flow coming in, there's a few different things that we can do. So for someone like that, we always suggest looking at the tax returns, because I've been doing this for so long, and I've got a couple of I've got one really solid, trusted tax preparer, CPA, who I've been working with for probably about 15 years now. His staff is phenomenal. I would say let's take a look at those. Let's take a look at those tax returns and see what we can do to help spruce them up, make them look good, because there's all kinds of legal ways to increase your income while still lowering your tax liability. Okay. The next step we'd look at is we take a look at some of those bank statements, whether they're personal or business, and see what kind of inflow is coming in with cash and capital, and take a look at what kind of money is going out, the outflow. Then the third thing we would look at is, depending on what kind of down payment and credit score, we could also do just a P&L only loan without looking at bank statements or tax returns at all. So, and there's a few other things that we can do with that too. But that's probably a good start. That's probably where I'd start.
Yeah.
Nice.
And then kind of going back to first-time home buyers.
Sure.
Someone that has never done it, right? Where do you suggest for them to start? And usually, how long does it take from start to finish to get approved for a loan?
For a first-time home buyer, it's actually pretty quick for the most part, where you could get somebody approved like in a day or two, sometimes less than a day. As long as they have all their documentation. So like a traditional first-time home buyer would have pay stubs covering the most recent 30 days, W-2s for the last couple of years, tax returns, bank statements showing that they've got the money saved, or money in a 401k, or a combination of both. And you could really get somebody like that qualified within honestly, you could probably get them qualified in about 15 minutes, really, nowadays.
Really?
With the technology like you were talking about earlier with DU and LPA.
Yeah.
It's about 15 minutes, as long as you have all the documentation. It just depends on if they have a credit freeze and you can't run their credit, or if they don't have all their pay stubs, or forgot a W-2, or those kinds of things. But, I'd say a day or less is always good.
And what are some mistakes to avoid as a first-time home buyer?
Waiting.
Don't wait. Call
Mark,
me.
how many times have you heard, "Oh, I'm going to wait to buy. I'm going to wait."
Every day.
All the time. And it's funny.
The market's going down.
Yeah, well, it's funny.
Crashing.
It's funny because we're all in the business here, and we obviously we know we need buyers and sellers today, tomorrow, next month, and next year. But what people fail to really understand is that, and I never understood this until a few years ago, that the old adage of when is the right time to buy a house? It's now. It really is now.
Yeah.
Because you're going to save money on your taxes.
Yeah.
You know, you're going to get some appreciation. Your quality of life actually has been proven on different studies throughout the last 20, 30 years that your quality of life changes when you are a homeowner versus being a renter.
Yeah.
You know, and that's also for yourselves, for your children and your grandchildren, or
Yeah.
if you're single, it actually, you know, ripples down to generations. So there's a lot of intrinsic value of owning a home.
Yeah. I had a client just yesterday. She texted me and she's like, hey, I think we're going to just hold off on buying a house right now. You know, it's just so expensive and I don't think it's the right time. So I'm like, okay, cool. I'll call you later. So I call her later. I'm like, so what's going on? Like, you know, what's the root of it? Like, how are you feeling? Because I wasn't about to give up on her.
No.
You know what I mean? It's just so expensive. I'm like, look, it's never not going to be expensive to buy a house in California. It's always going to be expensive. And yeah, it might feel like a little tough in the beginning, right? But 2 years from now, you're going to say, I'm so happy I bought this house.
6 months, they're going to be so happy.
You know? So I'm like, don't let the like nervousness or like the doubt get in your head either. Like, you can do this. And I think that a lot of like first time home buyers just need that encouragement because they're hearing the news or they're hearing like mom and dad talk about like the freaking sky is falling down, right?
Yes.
But I always just like you're gonna like really just enjoy your house and you're gonna be so happy that you did this.
Not just that, but when you calculate how much rent you pay, because rent's going up like crazy.
Yes.
Yeah.
You think of how much you spent over the years, you're like, wow, this was my down payment.
Yeah. And I
for
just
sure.
adding value. I don't know if you saw my Instagram video yesterday.
Maybe I did. Maybe I didn't. I don't know.
You saw it.
I did.
But having a house like that and being able to add to it, you know, I think that's amazing. And I know that
It's huge.
Cal Halfa does have an ADU grant program.
They do.
Can you tell us about that?
They do. Nope, I can't. Really? I'm kidding. Really? Thank you for laughing, Keith. Look at her face.
Come on, can you catch on?
Sheesh. So that grant program is available through CalHAFA, which is for California only, through the state, and it will enable you to basically build an in-law quarters or an in-law unit or a granny flat on your property. And because of some of the recent changes to California state law, where you can't add to a single family despite no matter what the zoning is, that's going to be a massive boon for people who have generations living in their same house, where you've got maybe mom, dad, or mom, dad, and kids, or mom, dad, kids, and grandkids living in their properties. This was going to open up a great way for you to be able to still have room for everybody at your own home, basically. So,
Wow.
And it's a grant. I don't think they ever have to pay it back.
No.
They just have to see a certain amount of money in your account.
Yep.
And they pay the contractor directly.
Sounds like a deal.
I think I need to do one.
It's a great deal. It's a great deal. Like everything else, as long as you qualify, that's the important part.
Awesome. Well, Mark, you've given us some valuable information today. You know, I think a lot of people can definitely take this home and, you know, try to help themselves or, you know, gain some more knowledge from it for sure.
Yeah.
Do you want to close up with anything?
Yeah. If people want to call you, realtors want to reach out, you need a deal done, where can they reach you?
Oh, you can give us a call at 714-602-1334, or Instagram is always a great spot too. It's Marc Viana, MarcViana.MVP Lending, and you send me a message.
Awesome. Well, thanks again, Mark, for your time. You know, your time is valuable and, you know, for coming on here with us. Thank everybody for listening. Please log on, see our sales webinar with Angel. We have it every week. You can always follow us for more information. Other than that, have a great day.
Bye, listing agents. See ya.